Hi, and thank you for watching us here at Tax Talk UK, where we talk about all things tax and try to help you to understand how the rules and the tax specifically applies to your individual circumstances. So today I'm going to talk a little bit and answer some questions on tax on pension, lump sum payments. And before I do, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you need to, as well as finding information on a whole host of other topics, all aimed at helping you to understand tax and how it applies to you individually. So back then to receiving pension payments and how this works for tax purposes. So following quite a few different questions on this topic, I just wanted to talk about this generically, which hopefully will help you to understand how tax will apply. So generally speaking, once you are over the age of 55, you are able to take 25% of your pension, assuming that it's qualifying for, you're able to take 25% tax-free. Now, that 25% is it's tax-free, and you won't receive a P60 or a P45 for it, or should I say you shouldn't. There have been some mistakes made by pension providers recently where they have incorporated that information, which that could have big tax liability consequences for people. But that figure shouldn't, if you've taken some taxable as well, that 25% shouldn't be included. That doesn't need to be declared to HMRC. There's no tax liability due on that 25%. But if you take more than that, or perhaps it's not qualifying, or you've already taken your 25%, then anything that you take that is taxable, and this is what I'm looking to talk about today, that will be added to your other income. So let's work backwards from the end of the tax year, because then it's easier to see what we're aiming to achieve at the end of the tax year, and then we work back to see how that's achieved, and then you can see the implications for yourself. So at the end of the tax year, with any scenario, if you have income that's not taxed at source, or if it's only estimated, then you would be looking to potentially complete a self-assessment tax return, although that's not a requirement just because you've received taxable pension and payments, if your other scenario and circumstances don't require you to. But at the end of the tax year, what's going to happen, whether that's done as part of a HMRC review or a self-assessment tax return, is all of your income for the tax year is going to be added together. And this, therefore, is then going to give you the rate of tax that is due. So generally speaking, you would have your personal allowance, which would be no tax due, from there up until high rate tax threshold. You would pay 20%. Above that, you would pay 40%. Over 100,000, you would start to lose your personal allowance, and then over 150,000, you would pay 45%. So what the thing that's crucial to remember is that the pension amounts that you've had, again, we're only talking about the taxable amount here, is going to be added to your total income. So say, for example, if you have 50,000 of employed income, and so you just under the high rate tax threshold, but then you have 10%, £10,000 as a lump sum taxable from your pension, then then your total income of 60,000 pushes you into high rate tax. So therefore you would pay 20% up until the threshold, and above that you would pay 40% in this scenario. So this is the important thing to remember, is at the point that your pension provider pays your pension to you, they are going to be using a tax code, either a standard tax allowance or a tax code provided by HMRC. But at the point that they make that payment, and even at any other point, they're not going to know other income that you have. So, for example, if you still have employed income, your pension provider won't have access to know how much that income is, and to be able to add it together to work out overall what your total income and the exact amount of tax that's going to be due. So they're going to just be applying the tax code as they are given. So it's likely that some tax will be deducted, but it's not necessarily going to be the correct amount that's due on that pension lump sum. So this means that at the end of the tax year, when all of your income is known, and if you complete a self-assessment tax return, it will all be obviously included in that. Or if you don't and you don't want to, then HMRC will review your total income, and then they're going to assess your total income, and then they're going to calculate the total liability due, and then they're going to deduct from that any tax that has been deducted at source, which of course is going to include any tax that the pension provider has deducted. And then if the tax deducted is more than the liability, you will receive a rebate for overpaid tax. If it is less, then you will need to make sure that you pay that shortfall. So sometimes it can be concerning to people when they receive their pension lump sum, and they identify that they have paid more tax than they will need to pay in the year. Then this is the reason why this happens, and any overpaid tax will be reimbursed at the end of the tax year. If you don't need to complete a self-assessment and you want to speed up the process, then you can contact HMRC to ask them to review the total. But it is important to understand that it's going to be very unlikely that when your pension provider is paying the lump sum, again, just to clarify, we're only talking about the taxable element. It's highly unlikely that the tax that they deduct is going to be the actual liability that's due on that money. And that's for a variety of reasons, but mostly because they won't know the total income that you're going to have in the year. So you can make a rough calculation yourself of what you expect your total income to be. So say, for example, in this example that I used earlier, where somebody's income is it just takes them up to the high rate threshold, then you know really that any pension lump sum that you're going to receive is going to be at 40% tax. So then you can sort of see whether that's what's been deducted. If your income is under the high rate threshold, and you know that even adding the lump sum, the taxable lump sum that you've taken, keeps you within standard rate, then you know that that's what's due on the pension. So again, this is a way of comparing what has been deducted and actually being able to understand what will need to be deducted to know whether you're going to have any overpayment or underpayment at the end of the tax year. So I do appreciate that it can be confusing, especially when you factor in the 25% tax free. But as I say, that is completely taken out of the equation. It's not added to your income to establish which rate of tax you're paying, and it won't be taxable. It won't be included anywhere on your self-assessment tax return. So when I'm talking about the tax, I'm only referring to the taxable element. So as I mentioned, just to recap, the important thing to understand is that income will be added to your total income for the year and taxed accordingly. The tax that's deducted at source is unlikely to be the exact liability that's due. So it's important to have some sort of understanding on what the liability will be, and compare that with the amount that's deducted, so you understand whether you're due to have a rebate or an underpayment. Because to my mind, there will be nothing worse than having that lump sum and assuming that all the tax has been paid, and then finding that there is a shortfall of tax liability, because you would want to obviously keep that aside to make that payment. And then, of course, just another thing to consider if you are withdrawing taxable money from your pension, is bearing in mind that it is added to your other employment, whether it's appropriate for you to take that all in one tax year, or whether to take it in sort of broken down amounts into different tax years. And there's lots of things to consider with that, not just the tax efficiency side. So as always, if you are struggling, if you don't understand, then you should take advice. Of course, it's important to understand in this scenario whether you need to take advice from somebody, an expert in the tax side or an expert in the pension side. But as always, if you do need some help and you are seeking advice, please make sure the person that you're seeking advice from is qualified to give the advice that you're seeking. If applicable, they're a member of a professional body and that they hold indemnity insurance. And hopefully this has been helpful. And as I mentioned earlier, please do remember to subscribe to the channel and like the video if you find the content useful. Thank you for watching. Goodbye.